Hello, greetings. Welcome to Dividend Blasters. This is our 94th video. Topic today, GPIQ, the unstoppable NASDAQ-100 covered call winner of 2025. That's right. That new ETF by Goldman Sachs is killing it. Year to date, they have the best price and total return performance. And they're crushing it and they're beating their closest rivals. I'm going to talk a little bit more about that, but before we do, little housekeeping. Quick disclaimer, I'm not your advisor. What I say, it's not financial advice, it's my opinion. It's also based on my research and experience as an independent investor for more than 30 years. This video is for information and education. So do your own research, do your own due diligence, consult an advisor before moving forward with an investment. So let's just take a quick look side by side. If we look at GPIQ against its two closest rivals, Neos Fund's QQQI and JP Morgan Chase's JEPQ. I'm going to look at two things here first around performance. I'm going to look at price return. I'm going to look at total return. Price return, so that's just price appreciation. It's killing it. So 2.24% year to date by GPIQ. QQQI just an eyelash under 1%, so they're not losing money price wise. JetQ is. They are losing. They are not getting a positive price return year to date. They're minus 3%. You can see it there in black and white on the graph. Now let's take a look at total return. And recall, total return is price return plus dividends reinvested. So let's take a look at that. And you know what? We invest in these because we want those dividends. We want that income. All right. Year to date, total return GPIQ 8.69%. That's very different than the 2.24%. This is the difference. Here it's the dividends reinvested. QQQI is very close total return. It is 8.48%. So their dividends, their yield makes up a little bit for the less than price performance of GPIQ. JEPQ, I don't know. They're way back there. They're less than 3% total return. So, you have to ask your questions. Why is this happening? Well, it's happening for a variety of reasons. I can look at the expense ratio. I can say, well, GPIQ is cheapest. That's the reason. That's part of the reason. That's not the whole reason. So if you look at them side by side, the expense ratio for GPIQ is 29 basis points or 0.29%. So for every $10,000 you invest, you're going to pay $29 a year essentially in management fees. QQQI is more than double. It's 0.68%. It does add up. The bigger your account gets, it does add up. JEPQ is close. It's 0.35%. So, but that's not the whole story. That's just part of it. And then, you can just see the age of these. JetQ has been around much longer than either of them. QQQI is it's the newest. And then you can see the assets under management. JetQ dwarfs GPIQ. QQQI is also about 3 times the size of GPIQ. GPIQ is a hidden gem, but it won't be for long. It's just performing so well. So let's dig a little bit deeper. The reason, and I'll just kind of, cut to it. The major reason is it's around the covered call strategy. And there's a lot that goes into a covered call strategy with a covered call ETF. And I summed it up here, but I'm going to walk through it a little bit. So GPIQ and QQQI both have more flexible covered call strategies than JEPQ. And let me elaborate on this a bit. GPIQ, they write covered calls on a range. And that's why we call it a dynamic or a flexible approach. Anywhere between 25% to 75% of their portfolio. So they're not going to write calls on everything. And it's really going to depend on market conditions. So, they can adjust where and how much they're writing these covered calls against depending on market conditions. And why do we write covered calls? We write them for income. We write them for cash. And I mean, I've written hundreds of covered calls on stocks. And you know what? When the market is down, I'm more excited to write covered calls because I'm going to benefit. Um, I'm going to get cash premiums based on those covered calls, just based on my holdings. Do I write it on all of them? No, no. When I started out, I used to, but then you miss the upside. So that price appreciation. So you want to hedge your bets, and that's what GPIQ is doing. So like here we go, during strong market runs like this year, we've had some volatility, but recently GPIQ can write fewer calls, and they're basically preserving more of that upside from rallies, especially from the tech growth, like companies like Nvidia in particular, and they're still getting that income. So they're not going to, because you know what happens when you write a covered call and everything, and the market just blows past your strike price. Your call is going to be assigned. Your option is going to be assigned. Your shares are going to be sold. You keep your cash, but you've missed that upside. So GPIQ is doing a great job of managing that. QQQI and JEPQ, they're kind of typically capping more of their upside. And I'm going to say this applies more to JEPQ. JEPQ writes their calls on. Uh, Let me say a couple things first. JEPQ is often referred to as a NASDAQ-100 cover call ETF. It is not. They do not write calls directly on NASDAQ 100 holdings. They are writing calls via equity linked notes uh, to holdings or to stocks. Actually, let me just say it's to stocks in the NASDAQ 100, but above and beyond that. So while that is useful and helpful, there are some drawbacks to it. There's a little bit of a drag. I'm going to get into this in the next slide because you're not writing against direct holdings. You're writing against notes, equity linked notes. They're linked to the holdings. So you're really going to have less responsiveness in how you react to a market condition. QQQI is flexible. It's really almost as flexible as GPIQ. I'm going to say the difference here is that basically GPIQ is just doing a little bit of a better job of writing those covered calls. It's that. I'm going to sum it up here. It's that, and it's also the difference in the expense ratio. Think of it. 29 basis points for GPIQ, 68 basis points for QQQI. That does add up. All right. So, and I'm going to kind of foot stomp this and maybe reiterate a couple of points. Um, you know, there's basically a more active approach here with GPIQ. And so, what does that mean? They're going to be able to harvest more premium income while still benefiting from that large price appreciation. And that's always been a challenge. When you invest, do you want the cash or do you want the price appreciation? And with covered call ETFs, essentially you kind of forego some of that price appreciation for the premium income. You do. What GPIQ is doing is they're optimizing the best way they can to give you the best of both worlds. JetQ, on the other hand, is really more income focused. So, if you look at the price performance over the last year or 2 years, it's kind of flat. Might go up a little bit, kind of goes up and down, but it really lags in growth. And that really reflects this whole thing with the equity linked notes. And I think it also really reflects um, their strike price selection. They are very likely selecting strike prices that are at the money. And what happens when you're at the money? Well, when you're at the money and you're in a bull market, your shares get called away and they're sold. And guess what? The market keeps going up, so you lost the upside. So to me, that is really the bigger story here with JEPQ. It's that and also the equity linked notes. So I mean, look at QQQI and GPIQ, and QQQI is doing a really good job. They're right there, total return with GPIQ. GPIQ is just doing a little better, and it's really because they've had a better price return, and also they have a lower expense ratio. And I really think that's the difference between those two. And again, I just mentioned that at the money strike price for JetQ. It's essentially um, they're at the money and strike price selection, and so they're getting the cash. They're maximizing that premium, but they're missing the outside. Contrasting GPIQ, they don't put all of their uh, portfolio forward to write cover calls. They're dynamically adjusting anywhere between 25 and 75% based on market conditions. So they want to capture that price appreciation. They want to capture that upside for their investors. So that's what they're doing. Um, and then also another thing worth mentioning, and I did say this earlier, JEPQ is not a NASDAQ 100 covered call ETF. It is, and they don't call it that. Uh, but people they say, "Hey, this is tech heavy. This is a Nasdaq 100." It's not. It actually has a broader exposure through the equity link notes um, beyond the Nasdaq 100. So there's really less concentration on the the juice out there of the bull market. These tech stocks, we're in a tech bull run right now, bull market run, and that's where it is. And so it's a little bit more diffused than with GPIQ and QQQI. And so it's really that's part of the story as well. And it's the structure of how they're approaching their covered call options strategy. I already spoke to the lower expense ratio. That's part of it. I also spoke a little bit to the equity linked notes. And here's a little bit more language. The use of equity linked notes can expose JEPQ to additional costs or drag not faced by QQQI or GPIQ that are using direct covered call writing strategies. So they can be more responsive. They can react quicker to market conditions. With equity linked notes, it's a little bit more rigid, less dynamic. So, folks, that's kind of those are the major points, and you can look at these side by side, and really the major takeaways here are you can see the check marks, the price return year to date. GPIQ is killing it. The total return, they're killing it. They're also cheaper. I didn't check it there. I should have. Than the other two. Now, the dividend yield is less than both, but that's not the full story, especially in these um, you know these wild bull run conditions we're going through. That's going to be less important. And folks, that is it. I hope you found this to be informative and enjoyable. And before I close, just a reminder: as an affiliate partner of Seeking Alpha, I can offer discounts to the premium subscription as well as Alpha Picks, where you get 2 free picks every month if you subscribe. And those Alpha Picks are phenomenal. They're killing the S&P 500. The premium, you get 24/7 stock analysis and ETF analysis and updates. Absolutely wonderful. And you know what? You can get the bundle, which is a little bit of both. It is both. I subscribe to both of them. I'm a longtime subscriber of Premium and Alpha Picks. And I'm a more recent affiliate partner, so I can offer these discounts. You can check out the links and the QR codes to the right, and you are taken right to the deal. Um, anyway, I'm also, and here's a little bit more description of these subscriptions. And as a reminder, if you want to check out my content, I'm on other platforms such as X, Instagram, and Facebook. Folks, hope you enjoyed this video. If you did, give us a like, share with a friend, and until our next video, have a wonderful day, and God bless.